Welcome to the Retirement with and On Purpose podcast. I'm your host, Trevor Lawson, and this show is all about helping you not just reach retirement, but truly thrive in it. You've put in the work, now let's make sure you can enjoy every moment to the fullest. Today's episode is revisiting a topic discussed many episodes ago, the sequence of returns risk. So this is one that deserves revisiting and frankly deserves perhaps an annual episode on because it's so important. So the inspiration for this particular episode comes from an article in the Financial Advisor magazine by Wade Pfau, Pfau, 4 Ways to Beat Sequence Risk. So Wade Pfau, he's a Dallas-based retirement specialist who is considered a thought leader amongst retirement planners. Anything he puts out, in my opinion, carries a lot of merit. So we'll go through his 4 strategies to beat sequence of returns risk and spend some time talking through each of them. So starting here, bumpy markets are no fun for anyone, but for clients about to retire or who are recently retired, volatility can be downright terrifying. That's because market drops right before or early in someone's retirement make it difficult for them to make up the returns later, a phenomenon called sequence of returns risk. So if you guys want to see a neat chart on this, there's a lot online, but if you Google sequence of returns risk and perhaps pull up an image showing returns early on in someone's retirement journey, and if they are poor versus comparing that to an investor who has very positive returns early on in their retirement career, there's a profound difference in how much money is remaining in their portfolio at the end of a 25 or 30 year period. And if you can't find one of those charts, I've got several to share with you. I'm quoting Dr. Pfau here. We're really vulnerable to market returns around the retirement date, in the years leading up to retirement, and then especially in the early years of retirement. It's not just the average return over your retirement that's going to determine the success or failure of the plan. It's the order that the returns come. Bad returns early on, balanced by good returns later on, can't help you. If you get good returns early on, balanced by bad returns later on, you're smooth sailing. One of the problems for these investors is that they want to avoid selling assets at a loss. Yet retirees taking distributions have to sell assets in every market. So that's the biggest issue, in my opinion, with the sequence of returns risk is you've got your retirement portfolio, and traditionally you've been saving in it on a consistent basis. So the volatility, the ups and downs, hasn't been problematic because even when it's going through a downturn, your new contributions are helping really buffer that portfolio and frankly even buying in at respective low points, allowing you to buy more shares of what you own inside of your retirement plan at discounted prices. The challenge becomes, though, once you are no longer adding new money to that plan and let's say you experience that same volatility, well, we're going through a downturn, and then during that downturn, we're having to take money out for income purposes. That's really a double whammy and can be difficult to overcome over time. So Pfau suggested advisors consider 4 different techniques, all of which can accomplish the goal of protecting clients from sequence risk. One way is to spend conservatively. The second is to use a flexible spending strategy. The third is to reduce portfolio volatility. And the fourth is to use a buffer asset during periods of poor returns. So we'll spend a little time on each of these. The first one being spending conservatively. He said that to do this efficiently, retires can do a number of things. One being delaying Social Security until they are age 70 and build a bridge to cover their spending between the day they retire and the day they start collecting. The trick would be getting through those years between the date of retirement and the date of taking Social Security and doing so in a way that sidesteps sequence risk. So the solution's not going to be taking a certain amount straight up from their total return invested portfolio. that would just amplify the sequence risk. Instead, the client, you all, could find ways around the risk by using something like Treasury inflation protected securities, bond ladders, other strategies to really create a more sustainable bridge between your retirement date and when you start Social Security, and a bridge that would be less susceptible to the ups and downs in the market. So that's one consideration, is spend conservatively and really have that bridge of monies to use to allow your Social Security to max out at age 70. The second one is a flexible spending strategy. So the second approach is, here retirees spend more in market upturns and less in market downturns. That way they can avoid selling as many assets at a loss. So coming off years like last year and frankly the past 3 years, for folks that are adopting the flexible spending strategy, well, they've been able to spend more over the past 3 years because we've been in a very healthy market. But if you go back to, say, earlier years, think back to the early 2000s, 2008, when the market was going through a downturn, with this strategy, you would need to be able to spend a little bit less, allowing your portfolio time to recover. The third option is reduce portfolio volatility. So with this particular strategy, you are just looking at investments that can reduce the ups and downs in your portfolio. So we've talked in the past about a bucket strategy, having different retirement buckets that are going to be accessed at different stages in retirement. The first bucket, the one you're going to access most early in your retirement years, that's going to be invested very conservatively. And then, buckets that you may not access until later in retirement can stomach some more of the volatility in return for more growth potential. But just reducing the volatility in general by either introducing investments inside your main portfolio that are more defensive or protective in nature, or taking that bucket approach can help reduce the portfolio's volatility and in turn reduce your exposure to the sequence of returns risk. And then finally, use a buffer asset. So with this technique, the retiree holds an asset outside of the portfolio that does not decline in value along with the overall markets, and then taps it if necessary to avoid selling portfolio assets at a loss. So with this particular approach, you've got your retirement nest egg, you're using that for income purposes, but let's say we go through a 2008 type scenario. In this situation, you've got an asset outside of your primary retirement account that you're going to rely on until the market recovers. So Pfau said there are usually 3 types of buffer assets that he's comfortable considering. I'd add a couple of these, but one is cash, and there's cash alternatives. So, CDs, treasuries, money market funds, there's different subcategories within the category of cash, but cash. The second is a variable rate home equity conversion mortgage or reverse mortgage. So home equity, for those that have a lot of it, can be a worthwhile consideration tapping into during periods of a market downturn. Again, just to keep you from having to draw out excess funds when the market's going through a downturn. And the third is the cash value of a whole life or permanent life insurance policy. That can work well for those that have that asset class as part of their overall portfolio and have built up a healthy cash balance. The idea is, if my portfolio looks to be in trouble, I'll temporarily tap into the buffer asset to meet expenses, giving that portfolio an opportunity to recover. He said, adding that the reverse mortgage could potentially work with the other approaches to manage sequence risk very well. So those are 4 strategies worth considering to combat this sequence of returns risk. Just like with all facets of retirement planning, there's really no one-size-fits-all solution. These are just 4 strategies for your consideration to help combat this very real risk and make sure that we can extend our portfolio as long as possible and ultimately maintain the lifestyle that you've grown accustomed to as long as possible. As always, appreciate you tuning in today and look forward to being with you again soon. Take care. Thanks for tuning in to the Retirement with and On Purpose podcast. I hope you're walking away with new ideas and a fresh perspective on how to make the most of your retirement journey. And remember, retirement isn't the end. It's your time to live with purpose. Until next time, I'm Trevor Lawson. Here's to a fulfilling and thriving retirement.